You might know your mutual fund SIPs, your goals, even your asset allocation, but here is probably what you never knew. You are born to invest in a particular way, and if you don't know which one you are, your returns are already decided. There are three kinds of mutual fund investors: rabbits, assassins, and hunters. Only two make money, one loses every time. Which one are you? Do you know that picking a winning stock or a portfolio is statistically stacked against you? Let's look at this data. Over the entire history of the global stock market, as per this research in this book, only 45% of the stocks have ever given a positive return. That means the probability that any random stock will make money for you is barely 50-50. Of that, 25% of the stocks deliver above average returns, and that is your alpha creator. And here is the clincher: just 4 to 6% of all the listed stocks account for most of the total wealth created in the market, which means 95% of the time you're not sitting on a multi-bagger, which means losses are not a mistake, they are part of this math. That's why every portfolio, even the best ones, will have plenty of stocks that do not work out at all. At any point in time, you will be holding on to some winners, some laggards, and some outright losers. And that is very normal. That's how markets work. Even those 4 to 6% multi-bagger stocks did not rise in a straight line. On their way from 100 to 1000, they fell 8 to 12 times by more than 20% each. And almost every one of them had at least a 50% of a crash in their journey. So if you think riding a multi-bagger without pain is possible, you're dreaming. So the question is not how you find them, it is how will you survive them. What do you do when you're sitting on losses? The way you behave when losing decides if you will stay in the game. The way you behave when winning decides if you will build wealth. Let us see both sides of this coin, because that is that part of investing which nobody likes to talk, and that is exactly what we'll be talking today in this video. Let's simplify this one glance framework: who to be, who not to be, and what to do in both phases of the market. There are three losing phase personalities. When your portfolio is making a loss, an investor can be identified by one of these types. First is the rabbit. He is the freezer. When the markets fall, the rabbits freeze. They tell themselves markets will come back, but it often doesn't come in the same way. They confuse conviction with ego. They do not rebalance. They don't cut losses. They justify. If you have ever stared at your portfolio and done nothing, you were a rabbit then. Second is the assassin, the cutter. Assassins act fast. They don't marry their stocks. If something goes down 25%, they sell without emotion. They protect capital like it is oxygen. Assassins survive because they play defense better than offense. Third is the hunter. He is the doubler. Hunters do the opposite. When good companies fall, they buy more. They understand that volatility is market's way of transferring wealth from the impatient to the patient. Hunters are very rare because they have to be both brave and also well informed. Think of it like a falling stock. Rabbits hide, assassins sell, hunters they add more. Now, in a winning phase of the market, there are two investing personalities based on what you do when the portfolio or the stocks are going up or winning. Again, there are two types of personas based on how you will behave and how you should be ideally behaving. One is the raider. He is the quieter. Raiders sell too early. They can't stand to watch a winner fluctuate a bit. They book profits very fast. They feel smart, and then they watch the stock double later. They think they are being very safe, but they are actually destroying the compounding, the portfolio returns. Second is the connoisseur. The connoisseur holds on to their winners for long. They take small profits along the way, but let the rest ride. They know multi-baggers don't look like multi-baggers in the beginning. So the key insight for a connoisseur is that he wins because they let time and conviction do the heavy lifting. Now let us move to the next segment, which is the execution framework. All this is good. How should you do? What should you do when you're losing or winning in the market? When the market phase is losing, meaning when your portfolio is losing, don't be a rabbit, be an assassin or a hunter. Review the thesis. Why did you buy them initially? And if that thesis is broken, then exit. If the thesis is in fact, add more. Now, when the market phase is in the winning side, when your stocks are doing well, when your portfolio is showing healthy returns, do not be a raider. Instead, be a connoisseur. Hold long, rebalance, let the compounding work. So the next time your portfolio falls, don't ask, why is it down? Ask, am I acting like a rabbit or an assassin, or am I a hunter? The truth is, you don't need more mutual funds. You need just better execution, because wealth is not made by buying right. It is made by behaving right. So tell me in the comments, which type do you think you are and which one are you becoming? So to help you here is the investor self-assessment type. Identify your execution bias and fix it. So when the market falls, what do? Do you book profits? Do you hold, or do you rebalance? And when the market rise, what must you be doing? Do you book profit, rebalance, or do you sell? The market rise, what must you do? Book profits, hold, or rebalance? You give a scoring on the way you will behave and use that scoring to understand what type of an investor you are. Then you tie it back to your mutual fund investing style. Even mutual funds try to solve this problem for you. They diversify, they rebalance, and they follow strict investment frameworks so that you do not have to react emotionally. They are designed to protect investors from their own impulses. But here is the challenge. Even with mutual funds doing all the heavy lifting, investors still underperform the funds that they invest in. Why? Because of behavior. The data shows that average investors' return is often 2 to 4% lower than the fund's own return, simply because of when they buy and sell. That's where a helping hand makes the difference. Most people think they do not need an advisor because they already know enough. They have ranking. But here is the truth. You don't need an advisor for knowledge. You need one for behavior management. Someone who makes you stick to a framework when your emotions tell you to do just the opposite. Because in investing, the biggest threat to your wealth is not the market, it is you. And that's exactly where you will need a coach to make sure that you stay on the course even when the markets do not. I often get asked which is the best mutual fund to invest in, and I've actually made 2 videos on this very important topic. One, why the best mutual fund is not the best you think it is, and another video that tells you how to handle this exact problem. So here is the truth. Every time investors rush to invest in a fund that is currently ranked the best fund, they are actually buying it after it has already performed well. And if you look at historic data, no fund stays best beyond a year or two. So what really is happening now? You are buying at the top, not before it became the best fund, but after it peaked, after it became the best fund. And once the performance cycle turns, the same fund starts slipping down in ranking. Investors feel disappointed and confused, and they repeat this. So the real question is not which is the best mutual fund, it is which fund will stay the best for you even when the markets continue to change. That's where process, patience, and right guidance matters more than chasing past winners. If you like the content of this video, please consider hitting the like button, share it with your friends, and consider subscribing to this channel.